Good morning, everyone. This is Marshall Giller bringing you the morning comment for February 23rd. Well, Greece on Friday gave in and accepted almost all the demands of its creditors. In return, the creditors agreed to extend the country's bailout agreement for 4 months. Greece will submit to the Eurogroup by this evening a list of proposed reforms. If satisfied, they'll endorse the list, which then goes to the various parliaments in the Eurozone for ratification, including, of course, Greece, which also has to ratify them. Now, despite all the drama, the agreement is really only a temporary measure that provides a breathing space while negotiations continue. The financing ends right before Greece must make 2 crucial payments to the ECB. Now, Greece doesn't have the money to make these payments, so discussions are likely to begin very soon on a possible third bailout for the country. During the 4 months, the two sides will negotiate the target for Greece's fiscal position. This is liable to be quite a difficult discussion as Europe wants Greece to promise to pay more than it can. One major concession, though, Eurogroup President Dijsselbloem said that Athens may be able to lower the budget surplus target, which is a key demand of the new Athens government. Nonetheless, we can expect another last-minute crunch. The difference is that this time, the government was elected and immediately thrown into negotiations with a 2-week deadline. It didn't have any time to prepare. The next time, Athens will have 4 months to figure out a plan B in case the Eurozone doesn't go along with its proposals. Having a well-thought-out alternative, which could include leaving the Eurozone, could boost Greece's bargaining position substantially. It could also make a Greek exit more likely, as there will be more time on both sides to prepare for that possibility. Now, looking at the FX market impact of the agreement, Eurodollar bounced back from the lows on Friday afternoon, but it failed even to touch the highs of Tuesday or Thursday. And its opening in Europe today virtually unchanged from its opening on Friday. The market's verdict, therefore, appears to be that while the talks were successful, they weren't so successful as to improve the prospects for the euro. The underlying tensions within the euro remain, plus the pressure of the quantitative easing program that will start next month. I remain bearish on the euro until further notice. Today's highlights, aside from Greece, the main point of interest today is the German IFO survey for February. All 3 indices are expected to have risen. In the U.S., existing home sales for January are forecast to decrease a bit. Dallas Fed Manufacturing Index is also coming out. As for the rest of the week, the highlight will be Fed Chair Janet Yellen's twice-a-year report on monetary policy to Congress on Tuesday and Wednesday. Also, Bank of England Governor Mark Carney testifies to Parliament, and ECB President Draghi appears before the European Parliament. On Friday, we get the usual end-of-month data dump from Japan, including the important CPI figures. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.